Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, Fundamentals Analyzer software tool. And I've got kind of an interesting video today to do. A lot of controversy over a metric that a lot of people use, a lot of people misuse, a lot of people don't know how to use, and that's called yield on cost. Now, I prefer to call this metric growth yield because I believe growth yield better describes the real value of this investment. You know, one of the big advantages of being a investor in dividend growth stocks is that you're looking for a portfolio that has predictability and consistency, a portfolio of stocks that can provide you a growing income stream. You know, like I like to say, you know, just like when you were working, you deserve a raise in pay today. So one of the things I'm going to do to talk about this metric is I'm going to go through the Dividend Champions. That's a group of about 140 plus stocks, companies that have historically increased their dividends for 25 consecutive years in a row or more. And, you know, I group this list here and I can organize them by PEs, earnings yield, dividend yields, et cetera. But I'm going to talk about 4 or 5 companies here that are all dividend champions. And what I want to do is I want to look at the perspective of yield on cost. Okay, a lot of people say they buy a stock, and the beauty of a growth stock, a dividend growth stock is that they give you a raise in pay every year. And the dividend is real predictable. So let's look at that. Let's start with my first example here, which is Church and Dwight. Now, I consider this one of the most consistent performing companies I think I've ever studied or looked at. I found the stock to be significantly overvalued for many years now. This is one of the insidious things about valuation. This has gone on, you know, really the blue line on this graph is because of the consistency of its performance. You know, the market has had a penchant for valuing it at around 20 plus times earnings. You know, you can, if I change this time frames, this line will change, but it's around 20 times earnings, where I believe fair value is 15. Now, there are times when you could buy the stock, you know, close to that fair value PE, but most of the time you pay a premium. But even given then, the premium got significantly high. You know, back in August, we had a 35 multiple. But here's what I want you to see. Here's what I want to focus on for the sake of this video, because what we're talking about here is, you know, predictability. What is the one thing in investing that is predictable? And to me, when you're investing in dividend growth stocks, it's the dividend. If I look at the price line, you know, the price can go up and down quite a bit, and that's going to happen. You know, they asked the venerable Ben Graham one time, the story goes a newscaster was, you know, hounding him for an interview, and he finally, you know, agreed to give him the interview, and the young man said, well, all I want to know, Mr. Graham, is I want you to share your infinite wisdom about the stock market with my readers. And he said, well, son, all you had to do was ask me. I can tell you that in 2 words. And I can tell you everything I need to know, or you need to know, or I know about the stock market in just 2 simple words. It fluctuates. And I think that's really evident when you look at the price line on any graph. These are only monthly closing stock prices, so they actually smooth it out. Now, in this case, we have a very consistent producer. You can see the earnings line is also very consistent. It's just year after year predictably rising at a rate of about 13.2% a year. This is an incredible growth stock. But now I want to talk about the dividend. The dividend line is very predictable. This company is a dividend champion, so it's raised its dividend every year for more than 25 consecutive years. Off the top of my head right now, I don't have the exact number, but you can find that pretty easily. But anyway, having said that, you know, when we go ahead and we look at performance, you know, we see that the dividend increased every year, year after year after year. Now, I do want to show you something here. It looks like the dividend didn't change here. It actually did, because it's a rounding. You know, it was paying, you know, 5 cents a share and a fraction. So the dividend, the cash dividend based on a $10,000 investment that I'm using here for my example, went from $130.52, a 1.3% yield on cost. Then the income actually increased to $134. That was only a 3.5% increase. And then we constantly go up here. Then I want you to notice all of a sudden in these later years here, we start going from low single digit dividend or yield on cost increases. And this is one of the values of yield on cost. And then all of a sudden we got into these higher, you know, almost double digit, and then even got into high double digit increases. Now, a couple of reasons for that. And this is my point. The yield on cost is a metric that does have value. When I'm looking at it from this performance stake, I could say if I bought the stock, you know, in December 29th of 2000 and held it over all these years, I could say my yield on cost today is 25.9%. In other words, this company is paying me $2,588.80 a year and growing. Last year it paid me $2,453.96. That's growing. That's getting a 26%, dividend return against my original investment. That's what yield on cost means. But I call it growth yield because you can see that the yield went from 1% up to 26% using round numbers. Now, the point is, some people get frozen by that and say, well, I can't sell this stock because its yield on cost, my yield on cost is so high, and I don't want to give that up. Well, the reality of it is, if we look at this stock from the other perspective, a more relevant perspective, number one is it's overvalued, and I do want you to notice it was significantly overvalued in July of last year, and we've already started to see a potential reversion to the mean, if you will, if not all the way down to the orange line, which is where I believe it belongs, but certainly it looks like it's headed down to the blue line. But nevertheless, the point I want to get at is the current dividend yield is 1.23%. So had you invested $10,000 in this stock back in December of 2000, today, your portfolio would be worth $221,000. Now that's capital appreciation. You also would have gotten $20,606 in dividends. Now let's assume you're living off the portfolio, just to put this into perspective. What that means is that you'd have already received more than 2 times your original investment back, from cash. So that, obviously is a hallmark of a great investment. But today you're looking at the company as a prudent value investor like yours truly, and you see that it's overvalued, and you see the correction started, and so you might draw the conclusion, well, hey, maybe it's time that I look for, more fertile ground. Now, before I leave this, I want to show you something else. The forecast growth rate for this company is about 6.93%. And that's by 18 and 15 analysts. So you've got 8 and 7% for the next year or so, but we are getting estimates all the way out to 2024, averaging about 6.9%. To keep that in the back of your mind. So let's move on now and let's look at another example. This is Altria. I still call it Philip Morris. The symbol's MO, which obviously was short for Morris. And this is your tobacco company. Okay, now when I look at the performance from a point of view of yield on cost, the first thing I want you to notice is, in contrast to what we saw with Church and Dwight, I originally started out with a 5% current yield, or yield on cost, if you will, after the first year, buying it on that same December 29th. But here the dividend grew every single year, and last year I got $3,338.48 on my $10,000 investment. My yield on cost now is 33.4%, even better than what we saw with Church and Dwight. That $10,000 investment has thrown off over $31,000, almost $32,000 in dividends. In other words, I've gotten more than 3 times my original investment of $10,000 back in dividend income. Now, I didn't do quite as good on the growth side. Okay, I want to make that point. My $10,000 would have only grown to $49,000. Now I add in the we'll call it $2,000 worth of dividends, and I ended up making 11% a year, about $81,558.52. But that's in stark contrast to the $242,433.19, or 17% annualized rate of return item 8 on Church and Dwight. So I'm saying, okay, if I was going to switch today, and this is where yield on cost freezes some people. If I was going to switch today, I would go look at Church and Dwight, and if I go back to the historical graph, my current yield, in other words, on the money I have in the portfolio right now, I'm only earning 1.23% currently. That's my current yield, even though my yield on cost is very high. If I switch that to Altria, or Philip Morris as I like to call it, my current dividend yield would balloon all the way up to 6.8%. That's a significantly, higher number. And I've got a yield on cost that's 33.4% had I bought it. But I'm assuming now that I don't own it. This is just the record. So this, this is obviously impressive. Okay, but the real key is, what I'm really looking at here is the idea that I've got a much better valuation. My blended PE is 11.48, my earnings yield is 8.71, and my dividend yield is 6.8% currently. So if I switched all the money I made on Church and Dwight, if that was, unhypothetically, and if that was the real world case, and put it into Altria, I would dramatically expand my dividend income. I'd go from a 1.3%, I think it was, current yield on we'll call it $250,000 worth of stock, to almost a 7% yield. And I'd be obviously throwing off significantly more income by doing that. Now, from a forecasting perspective, this company is expected to grow slightly slower than what we saw with Church and Dwight at about 6.1%. But because it is so undervalued, that would, if I just would like to go out about 2 years, that means I could make an annualized 29.2% annualized rate of return while I'm enjoying a 6.8% dividend yield. That, I want to point out, has actually been growing every year. And this is the real important, to me, perspective that growth yield, I call it, or yield on cost provides. It simply gives you a clear illustration. Looking at the average dividend growth rate also gives you that perspective, but it doesn't give it to you as vividly as looking at a stock and saying, gee, I put 10,000 in my first year, I got 500, halfway through I got 1,500, then I got 2,400, and finally I was getting over $3,000 in income. This is, you've worked hard for your money, you're retired, now you need to live off your portfolio. This is your money now working hard for you, and as I like to say, you deserve a raise in pay each year, just as you did when you were working. A good quality dividend growth stock gives it to you, and the predictability of the dividend is critically important. Now, before I leave these two companies, I want to go back to Church and Dwight and make another point. When I was looking at the dividend growth rate for this company, where it dramatically ratcheted up so much, I want you to note that came from the company having a very low payout ratio in all these years. This area below the white line is what proportion of earnings they were paying out. And then you could see they increased their payout ratio dramatically, and it's been steadily increasing. So when I review that, historically, the payout ratio went from, single digit, maybe teens, all the way to 40%, 35 and 40% in more recent years, which attributed to the growth rate. And the company's compound average dividend growth rate was 17%. But I want to just expand on this idea of yield on cost a little bit, because what really matters here, when you're using yield on cost, it can help you, ascertain how much income your portfolio is throwing off if you're a dividend growth investor, and, as I mentioned earlier, living off the dividend. So it can really help you, understand that, but it can also let you understand how much income you're getting and whether that income is actually fighting inflation. Here's Arrow Financial, another dividend champion. It was a high yield stock back in, December 29th, 2000, using that same time frame. It increased its dividend nicely every year on an average rate of about 4.7% in the equivalent compound average growth. And it would have thrown off, as a result, quite 160% of your original investment. It would have tripled, almost quadrupled your money in capital gain, giving you an 8.8%. But it's this idea of getting a raise in pay each year, of getting an income that's increasing each year so that you can fight inflation and maintain the standard of living that you're looking for. But here, you're looking at only a 4.9% grower, which I do want to point out kind of coincides pretty closely with how much your dividend income has grown. So yield on cost can be a very valuable metric, but it's never to be used in a vacuum and never to make investment decisions, because you want to look at current yield. So let's look at another slow grower like Consolidated Edison here. When you look at this company, it's only grown earnings at 1.7% a year. That's very typical for regulated utility. It's a very high quality utility. It does have a very consistent dividend record, and it does pay out a very high portion, 65 to 70% of its earnings in dividends. However, when I look at it from a standpoint of yield on cost, the yield on cost only increased from 5.7% had I bought it on, again, that December 29th in 2000. Last year, it's only 7.9%. So I did get a steadily increasing dividend income here on my money, as you can see, but the growth rate was less than 2%. I did get a lot of income, however. I got over 12,000 income, almost triple what I would have gotten from the S&P 500, I want to point out. But I certainly didn't do as well as capital appreciation-wise. But my point is, yield on cost, studying my yield on cost helped me, recognize that although I'm getting a raise in pay each year, I'm not getting it. So why would I pick a utility stock? Well, I might pick it in lieu of a bond. It's very high quality, and it's got this consistent year after year dividend growth record. Now, you can then go out and even get more exotic. You can look at a master limited partnership like Enbridge here. It's got a 7.3% current dividend yield. That's very, very attractive. It'd be another option you could. Now, you get involved with, taxes and everything with this particular company. I'm going to exclude that. Now, I'm just looking at the gross numbers here. So if I go to the performance, I start out with a 3.2% yield on cost. That balloons all the way up to a 33.8%. Again, I call this growth yield because the yield is growing each and every year. This would have paid out almost 3 times my money. Nice dividend income. I would have gotten really good capital appreciation, 5 times my money in growth, averaging about 8.3%, and add it all together, and I get almost 11% a year. So this would be another option that I could utilize if I had a Church and Dwight or any of a number. There's a lot of very, high quality dividend growth stocks out here that are dividend champions. You can look at a name like Colgate, Palmolive, for example. This is a stock that's perennially overvalued by the market, in my opinion, or given a premium valuation might be a kinder way of saying that. But the point is, this stock is always very expensive. Its growth rate has only been about 6%. I want you to notice it was very highly valued back in 2001. So if I'm looking at performance, my yield was only 1%, but it only grew to 5%. And I got about $6,500 in dividends and made about 3 times my money total, dividends plus growth on this stock. So yield on cost is a valuable metric, but it can only and should only be used in conjunction with everything else. Current valuation, current dividend yield, the valuation of, when you're examining yield on cost, what was the value of the stock when you first invested in it, and all those other factors. Ultimately, since I'm known as Mr. Valuation, that's what I care about most. But anyway, this is my take on yield on cost. It is a valuable metric. It's not a metric you make decisions on. It's a metric that you utilize to understand how your portfolio has performed and whether or not the companies that you're investing in are actually delivering you an inflation-fighting, growth of income. To me, that's what dividend growth investing is all about. Anyway, thanks for watching. It's Chuck Carnival. Look forward to talking to you again real soon. If you like the video, please like it. Give me a thumbs up, ring the bell, subscribe to the channel if you don't. My YouTube channel, I really appreciate y'all. Thanks for watching.